Okay, let's get started. My name is Jeff Lusick. I'm the head of the retail sales team here at Horizons ETFs. I want to thank everyone's interest and attendance on today's webinar, where we'll be discussing fueling the future, investing in alternative energies. Just wanted to set the table in the sense that the whole webinar, I'm hoping we can have a nice discussion for about 30 to 40 minutes, leaving some time for questions at the end that we can address for you. In the top right-hand corner of your screen, you would see a task bar, and on that bar there is the question panel where you can enter questions throughout this webinar at any point, and I'll either try to address those questions during or try to answer them afterwards. And if I can't get to all of the different questions, we'll try to follow up after the webinar. I also wanted to point out there's a handout section in that panel, and on that is the product lineup for all of the ETFs at Horizons ETFs, as well as the product sheets for 3 of the different ETFs we're going to focus on today. So why are we holding this today? I thought it was an opportune time. One, because last May, just over a year ago, we held a webinar on energy, positioning it as an opportunity at that time. This proved to be good timing. We focused on oil at that point, as well as we introduced the opportunity of uranium, which both have done quite well in that in the last year. So wanted to revisit this today, find out if those can continue to be opportunities. Is energy still an opportunity? And we also want to review some fuels for the future, or alternative energies. So uranium, but also discussing lithium and hydrogen. So on that's the agenda. So we're going to talk about why invest in commodities. Is there still an opportunity in commodities in general? Are these long trends? Talk about 2021 and beyond, future energy trends, the rise of alternative energy and commodities, and why there's this rise in alternative energy, and why is there a demand for that now? And then get a little bit more detail in, as I said, uranium, lithium, and hydrogen. So with us today is Nick Picard, who's a Vice President and Portfolio Manager and Option Strategist here at Horizons ETFs. He co-manages all of Horizons' global lineup of covered call ETFs. And before Horizons, he spent nearly 15 years as an institutional derivatives trader with Canadian and international brokerage firms. He specializes in quantitative strategies, trading options volatility and relative value. Graduated from the University of Waterloo with a Bachelor of Mathematics and is a CFA. And he definitely has a passion focus on commodities, energy, and the future fuels. So Nick, thanks for joining us. Why don't we start with commodities in general? They've done quite well in the last year and a half. So what's your view? Can this continue?
Well, if you look at what commodities have done in the past 10 years, even though we've had a nice rally here, over a kind of a 1-year period relative to the S&P 500, there's still, in my view, a lot of potential catching up to do. Ever since the global financial crisis in 2008, there's just been kind of pressure for the 10 years following the crisis on commodity prices in general. And as you can see from the chart here, which is the S&P Goldman Sachs Commodity Index, until recently, it really was more of a downtrend. So this uptrend is definitely kind of a recent phenomenon, and there could be more to go.
Yeah, so I see that in some cases, as the commodity indices are going down over a long period of time, the S&P is going up, and I guess that's because a lot of the companies are using commodities as inputs for their growth, and if they're cheaper, they're more profitable.
No, absolutely. And if you look at the performance of those two indices, it kind of tells the whole story. Over a 1-year period, we have seen commodities do well, and I think that's why it's more front and center in people's mind. But if you look at a 5-year period, the commodities index only up 7% annualized versus close to 15 on the S&P 500. And if you look at a 10-year period, actually, it's not on the chart here, but I looked it up, and the 10-year return on the S&P Goldman Sachs Index is negative, whereas the S&P 500 over that time frame is up 280%. So there's definitely a lot of room. If you look at the ratio between those two indices, there's a lot of room to make up some lost performance.
Yeah, a great 10-year period in the S&P 500 and not so great of a period for the commodities index.
Exactly.
And the correlation to those, we just talked about correlation to the S&P 500, but other things as well?
Well, and here's the thing. I mean, I think people have kind of, mostly ignored commodities over the past 10 years, mostly because the performance hasn't been there. But over and above, maybe expecting higher returns, commodities do offer an uncorrelated asset to other major asset classes. And if we are entering a period of inflation, which it seems like we have been in the past year, obviously off of low levels, but definitely seems to, more and more people are talking about an inflationary environment. This is the kind of asset class that could do well in that kind of environment. And so, when you're looking at your overall portfolio and your overall risk, adding commodities really kind of helps diversify that risk and diversify those returns.
Good. And touching a little bit more on those potential drivers of return other than inflationary pressures.
Yeah, I mean, inflationary pressures is a big one, but I think we want to look at is like what is going to be the situation going forward. A lot of things have changed. With the pandemic, our way of looking at the economy has changed, but also, a lot of governments have realized, maybe this is our chance to reboot the economy, spend a lot of money on infrastructure. You look at what the U.S. is looking at with a big infrastructure program, and renewing the electrical grid effectively, like going from a grid that produces a lot of emissions to a grid that produces much less emissions. That's going to take a lot of commodities. It's going to take a lot of investment, and so that could be, positive for inflation and positive for commodities.
Great. A lot of fiscal spending, a lot of rebuilding going on. Using the money and trying to create jobs and rebuild the economies as well as the infrastructure in those economies.
Exactly.
So we talked about sort of the 10-year performance in commodities in the S&P 500, and then I wanted to ask you how long commodity bull markets can last, and you sort of see that 10-year number in this chart. Can you expand on that?
If you look back at previous bull markets in the previous bull market cycles, and going back kind of like 50 years, and you see that they don't last just 1 or 2 years. The big bull markets have lasted a lot longer than that. And in the 70s, essentially, that was a long 11-year bull market, very inflationary period, and then kind of late 90s until the global financial crisis. And this was really driven by Chinese demand. And that was kind of a long 10-year market. So the question is, where are we at the cycle now? It would seem to me that it's, if we are headed for a long cyclical bull market, we're still early days. If you think that the bull market started, at the end of the pandemic, with the oil's trading negative, that would be a little over a year ago. And so there's still a lot of potential a long-term move, especially if we're headed towards a 70s style bull market cycle, or even if we're headed, towards a new infrastructure spend from not only global economies, not only developed economies like the U.S. and Europe, but also places like India, which still have a lot of catching up to do if you compare them to China.
Good. Yeah. So long trends, these trends can persist. We haven't seen, since the end of the last bull market has been 12 or 13 years. So maybe setting up for a longer trend of a bull market here in commodities. And I think we discussed some of this. The recent surge in the commodity prices has spurred the prospect of rising inflation. and led investors to economically sensitive stocks on that reflation trade. That includes the commodities as well as the producers of those commodities. They've been touted as a diversifier and a hedge against that inflation. And the commodities tend to do well relative to the dollar's relative strength in international markets, so can be a hedge there as well.
Yeah, exactly. We've seen recently with U.S. dollar weakness, that's definitely helped the sentiment towards commodities.
Yeah, correct. Yeah, and that's really worked out well. So, as I mentioned a year ago, we discussed the traditional energy a little bit more at that point, but we did introduce uranium as an investment opportunity. But now there seems to be more of an importance on zero carbon emissions. So I'm hoping that you can speak to us about some alternative energy investments, the opportunities, the so-called fuels of the future. We can revisit the uranium thesis, as well as introduce hydrogen and lithium. So, is there going to be a zero carbon future? And let's sort of discuss the energy markets from that lens, and what are the trends now, if that's the case.
Yeah, well, I mean, I think I think it's a very exciting time to be looking at, the commodities that we're going to talk about today, because, even without this entire move towards, zero emissions and clean energy, there would, in my view, definitely be increasing demand for the commodities we're going to discuss today. But this is definitely being fueled over and above by very aggressive targets that more and more countries are setting to reduce global emissions. And this is not just a political, this is not just politicians and rules under the Paris Agreement and whatnot. This is also being driven by businesses that are more focused than ever before on ESG factors, and investors are demanding more of companies and to reduce their carbon footprints. And finally, it's being driven by at the consumer level, household consumer choices. Everyone is being more and more cognizant of their environmental footprint. So we really have, three big drivers at the government, business, and household level driving this change.
Right. You certainly do hear a lot more about zero carbon and that goal within a certain time frame.
Yeah, so I mean, in this slide, like how are we going to get to this energy transition? That's the big question. Right now, over half of our energy electricity production comes from fossil fuels. Obviously, most transportation is still done using oil and fossil fuels. We have a big job to get us from where we are today to where we need to be. And I think what I hope our listeners will take out today is there's no one silver bullet. We're gonna have to attack this problem from many different angles. And so, nuclear power and hydropower are, currently provide 10% of the world's electricity. But that's going to need to be a higher number if we're going to get to zero emissions. All electric vehicles, currently they're growing at a very fast pace, but they're still kind of a small percentage of overall vehicles, on the road. But getting them to where we will need electrical vehicles to be, as well as plug-in hybrids, that's going to take a lot of lithium on the battery side and a lot of hydrogen and hydrogen infrastructure on the fuel cell side. And then finally, more and more countries are adopting these policies, like I discussed before. Currently, 50 targets, mandates, and policy incentives in place today to support hydrogen energy for transport, but also just zero emission targets, in general. So I think each of these points that we'll talk about, they have specific applications, and they're all going to help get us to where we need to be.
Right. Interesting. So 10% of all of the energy is made up of hydro and nuclear, you mentioned. So a lot of room continued use there or growing use there and other sources.
Exactly.
And we're obviously fortunate in southern Ontario with all the energy derived from the falls.
Yeah, and I mean, Ontario is actually, one of the leaders in terms of zero emission energy, hydro and nuclear, and that's something that other countries will be striving to match. If you look at hydrogen vehicles, yes,
yeah, the transportation. Yeah, you mentioned this and how the majority is still fossil fuel engines. So I mean, obviously we're hearing more about electric vehicles, but the trend here, do you think there's growth in hydrogen and electrical vehicles?
Yeah, well, I think if you look at the news, everyone's heard of Tesla, obviously. There's definitely been a big push on the electrical vehicles and the lithium-ion batteries. But what has been a little bit less followed is hydrogen vehicles. It seems like the trend for hydrogen will be in more industrial use, where you can use where you need the fast refueling, where you need extra power. Hydrogen provide more of that. Whereas on the electrical vehicle side, it could be more useful for kind of a consumer transportation, where you can plug in your vehicle overnight and you only need it for a small amount of time or a few hours a day. So there's going to be different applications for each of these, but it seems like we're going to need both of those in the economy if we're going to reduce emissions.
Good. And in addition to the increased usage of electric and hydrogen vehicles, it seems that and you mentioned it earlier, it seems like there is a lot more pressure from end investors, but specifically institutional investors, on ESG and responsible investing trends and how they're demanding more from the companies that they're investing in. Is this a trend or a driver for the continued opportunity in this space?
Well, absolutely. I think if you see today, there's not many meetings where you talk about asset allocation and asset management without ESG being part of that conversation. And it just means that there's going to be a lot more capital and money available for these opportunities that will be ESG friendly, and that means a lower cost of capital for those opportunities, and so maybe investment opportunities that don't have a good environmental record might have a higher cost of capital than investments that are part of the solution. And so I think that definitely will help drive the growth in those areas.
Right. So more money looking for the same opportunities in responsible investing or zero carbon emissions.
Exactly.
Yeah. So I mean, so the uranium specifically, as I mentioned, we talked about this last May, and we positioned uranium as an opportunity, and specifically our ETF, HURA. But we actually launched this ETF 2 years ago in May. So, Nick, I was just hoping you can revisit uranium, explain the opportunity that you still believe it presents.
Yeah, I think the uranium story has done really well in the past year, and I think the opportunity in uranium is the word is starting to get out, but the fundamentals are still very positive in my view. If anything, they've gotten more press, and there's a few things that have happened that I think make it even more positive. First of all, there's the existing nuclear fleet of 443 nuclear reactors. That is slowly increasing. The Chinese are continuing to build nuclear power plants. But I think what's the exciting development that we've seen in the past year is the number of nuclear reactors whose life is being extended. A lot of the reactors in the world were kind of built in the 70s and 80s in the developed world, and they're all kind of reaching their end of their life, where without some spending, without some capital expenditures, they would need to shut down. And the fact that governments are looking at the situation and realizing they cannot afford to close these plants down if they're going to reach emission targets means that they're willing to extend the life of these reactors by putting the amount of money necessary to keep them going. And I think that's a trend that perhaps not everyone saw coming. And so that's just going to mean more demand going forward from existing reactors, as on top of the ones that are being built as we speak. If you look at the United States is a big, is one of those countries where nuclear was kind of going down in terms of reactors were shutting down because they weren't competitive with natural gas. And just recently, Indian Point, which is the U.S. reactor in New York, closed on April 30th. And they had to replace it with natural gas power plants because there's just not enough wind and solar to make up for a lost nuclear plant. And so I think in Illinois, where they have a similar situation where 2 plants were supposed to close, they're doing the necessary to keep them open. So I think this is a trend that we're seeing on the nuclear side.
Yeah, definitely sort of a perfect scenario for that, in the sense that there's only increasing demand for energy in general. And yet now there's this extra pressure of lower carbon emissions. And so how are they going to meet that? And uranium and nuclear being one of those, and needing to update and continue the use of a lot of those plants.
Yeah,
Go ahead.
I think this chart also gives, to me, we've talked about demand, but one of the things that makes uranium fairly exciting to me on the commodity, as a commodity, is not only do we expect demand to increase like we just talked about, and especially with electricity demand, likely going substantially higher, but also the supply side doesn't look all that good. We haven't really developed any new mines recently. Kazatomprom is the leader out of Kazakhstan. They've kind of been the only country to really increase production in the last several years. But outside of that, there's really not been any new projects or coming online without higher prices. And so this is a good chart showing that disparity between what the supply outlook is like and what the demand is looking.
Right. So the demand increasing, supply not necessarily increasing, so providing this opportunity. So what's the price of uranium now, and what does that look like compared to sort of the peaks, and when were those peaks?
Yeah, so the previous peak was over at the same time as the previous bull market cycle, back when we thought China was buying pretty much every commodity, and the spot price got over $100 a pound at that time, over 10 years ago. Now it's trading at just in the low 30s.
Wow.
And so that's a significant. I mean, people talk about how oil is still below its highs, but uranium, it went as low as below 20 in about 2 years ago, and so it has bounced a little bit. It has come back a little bit, but there's still substantial potential move up if it's gonna surpass its previous highs. And new production from new mines outside of Kazakhstan in the high grade mines that Cameco has really need $50 a pound to be profitable.
Okay, good. Yeah. So you set up the investment opportunity quite nicely there with uranium, and we do have an ETF that allows you to get exposure with that, HURA, Horizons Global Uranium Index ETF. This was launched in May of 2019. It's designed to provide exposure to the performance of a basket of issuers, which are primarily involved in the uranium mining and exploration industry, or invest and participate directly in the physical price of uranium. So some of those top holdings in this ETF would be some familiar names like Cameco, Uranium Participation Corp, the big one you mentioned, the big miner, Kazatomprom,
Yep.
Yellowcake. And if you're looking to see what's in this index, you know, our website provides all those details for you. You can get access to this ETF and provide that diversified exposure for 75 basis points. It is an index that's rebalanced quarterly. Just showing you the performance of how this ETF has done in the last 2 years, and specifically year to date, a very strong year to date number, very strong 1 year, as I mentioned, since we sort of positioned this as an opportunity last May, up almost 100%, and since inception of 37.5%. So it has done well, but I think we've made the case that it can continue to provide an opportunity for nice potential returns that are uncorrelated to a lot of your other things. So next up would be hydrogen. So this seems to be a bit of a newer, maybe lesser understood or less known or less followed energy source, but it is starting to get some more attention. I do see it coming up in the media a little bit more. So Nick, what are your thoughts on hydrogen? Can you sort of explain how hydrogen works and the investment opportunity that it presents?
Sure, and it's true that, you know, relative to, you know, kind of lithium batteries and whatnot, maybe hydrogen has gotten a little bit less press, but it's certainly not going to be any less important, in my view, to get to a clean energy future. And so hydrogen is really a fuel, and when you use it in a fuel cell, it creates electricity, and it only produces water as a byproduct, which is you know, obviously much cleaner than an internal combustion engine.
Right. So yeah, zero carbon.
Yeah, exactly. But hydrogen can be produced right now. It's produced from a variety of domestic resources such as natural gas, nuclear power, biomass, and renewable energy. And one of the struggles, and this is a similar struggle that we're going to be facing on electrifying the economy, is that existing hydrogen production is majorly done by fossil fuels. And so, you know, the challenge is to get to a clean hydrogen economy will be to get low emission hydrogen production. But it's increasingly, if we can get to that point, it's increasingly seen as a potential to decarbonize the economy, not only for fuel cells and transportation, but also for power generation and also for industrial purposes as well.
Great.
And if you look at where, you know, traditional hydrogen demand has come from previously, it's used as fertilizers and crude oil refining. But, you know, what I would expect is that more and more of the hydrogen demand is going to be coming from alternative energy. And like I mentioned in the previous slide, there's different types of hydrogen, and they're kind of color coded. There's the blue. It's actually on the next slide there, Jeff. But if
okay, right there.
The black, gray, blue, and green, these are codes for how the hydrogen was produced, and so the black and gray are, you know, fossil fuels. Black is coal, gray is natural gas, and blue and green is from renewables such as wind and solar. There's even pink. Pink is from nuclear, and then blue is natural gas, but using carbon capture. And so the challenge is you know, getting more of that hydrogen produced from a low emission point of view, but also building all the infrastructure that a hydrogen economy would require, such as fueling stations, transportation of hydrogen. You know, but there's potential that we could use one of the appeals with hydrogen is there's a potential that we could use some of the existing infrastructure that we have today.
Okay, and this would be maybe used more with more fleets and stuff like that. I think I've heard some research on.
Yes.
Yeah, so the demand increasing for hydrogen, and as you mentioned, just that challenge of trying to figure out how to get it, and with the infrastructure, and then using it to again from clean sources to produce less carbon emissions.
Yeah.
So how can you invest in this opportunity if you see hydrogen as an investment opportunity? It turns out we are launching this ETF tomorrow. It's going to be launched on the TSX tomorrow. HYDR, the Horizons Global Hydrogen Index ETF, and it's designed to provide exposure to the performance of global publicly listed companies engaged in the development and production of fuel cell technology and equipment, as well as infrastructure, components, and systems for hydrogen generation, storage, and transportation. So all of that infrastructure that we discussed. And with this, it's all the exposure to US dollars will be currency hedged. So very important to note that. Also, same fee of 75 basis points to provide you instant access to this investment theme in a diversified portfolio that's rebalanced quarterly. Some of the top holdings here, a lot of them are the larger fuel cell companies. Nick, did you want to provide an example of why you think it's an opportunity or why you really like it as an investment?
Yeah, well, I think if you look at this lineup of our top holdings, you'll see a couple of names that might look familiar. In particular, Ballard Power, the Canadian company. People might remember Ballard from 20 years ago. Things have really changed and improved. The picture for fuel cells is in my view much better than it was then. And in fact, actually, I think Plug Power, which is the top holding here on the list, also a fuel cell provider, they announced earnings today, and investors like that. The stock is up 10%. But if you look at the top holdings here, we have several fuel cell companies such as Plug Power, Ballard, and fuel cell. But another one I want to point out here is Nel Hydrogen. They're a Norwegian company, and they're a hydrogen producer. They use electrolyzers, they use clean energy to produce the hydrogen. So this could be the way of the future. They're also focused on the hydrogen economy, like creating fueling stations and whatnot. So these are the kind of stocks that are the big the top holdings in this ETF.
Good. So obviously a diversified approach to get you exposure to this investment theme. And the index itself, it's a modified market cap weighted index. So companies with the largest market cap will receive higher index weights. It can be invested in small, mid, and large capitalization companies. But the companies within the index will be classified either as pure play and have a cap of 10% at rebalance, or a non-pure play, which would mean the lesser part of their business is focused purely on hydrogen, and the non-pure play would be a max weight of 4% at rebalance. Just important we note that this won't include companies that trade on Shanghai or Shenzhen, but could include companies which have Hong Kong listed shares of ADRs.
One of the things I want to mention there, Jeff, on the non-pure play point is if you look at the list of our top holdings, there's a couple companies there, Air Products and Linde, they as well as Chart Industries. These are big companies, but they're capped at 4%. That's why they're at 4% there. But they have different businesses, but part of their business is going to be focusing on this, infrastructure in the hydrogen economy and whatnot.
Yeah, part of their business is focused on it, so but not all of it. So which is why we would have the full pure play weight in those companies, but you'd still have exposure to their growth in that space. And then lithium. Let's talk lithium, which I learned is the world's lightest metal, which makes it attractive.
It is.
And I've heard some people refer to it as white petroleum. So can you explain lithium and the opportunity it presents?
Yeah, so like you just mentioned, it's the lightest known metal, and so that makes it a very good candidate for batteries for transportation. Because one of the big struggles with putting a battery on in a car is that they're extremely heavy, and so even despite that, a typical electrical vehicle will have 22 pounds of lithium in its battery.
Wow.
So that's quite a bit of lithium. And if you think at the number of vehicles that are in in the world today, that's a lot of potential future demand for lithium.
Mhm.
But
Yeah.
lithium batteries got started with cell phones and laptops and whatnot. That they're ubiquitous in the economy today. So this is a technology that's very, very well understood, and really getting it into electric vehicles just kind of potentially supersize that demand.
Right. Which is already there, but as the continued uptake in electric vehicles only increase that demand, and obviously that's what's presenting it um, as an investment opportunity, is that increase in demand. But we'll start. Can you talk to us about that sort of forecasted demand?
Yeah, and so if you look at this chart, this is a bit of a forecast of what the lithium demand uh, could be if we're going to be reaching yeah, our zero emission goals. And there's plenty of government mandates to ban the sale of internal combustion engines. And so these new cars are going to be like Teslas, and they're going to require a lot of lithium in their batteries. And so what we're looking now is, most of the current supply is being used for all the batteries that we have in the world for all sorts of different things. But the expected demand from the electrical vehicles, is likely to really drive a lot more supply, and so we're going to need more mines and more companies to mine lithium.
Mhm.
And Elon Musk always talks about that in a lot of his media interviews, about how one of their main struggles will be to secure enough lithium.
Yeah, yeah, to meet that ever increasing demand there. Okay, and I think you talked about how the demand is expected to increase significantly. Something else I just learned is that 75% of the lithium reserves are sort of in that triangle of South America.
Yeah, and that's one of the nice things about lithium, is that even though we'll need a lot of it if we're gonna change our vehicles to lithium ion powered electrical vehicles, we're going to need a lot of lithium. The good news is there's a lot available in that lithium triangle, which is where a lot of the miners operate. This is in the northern Atacama Desert in Chile, and then in the Salar Flats south of Bolivia, and then north of Argentina. Right in that area, lots and lots of lithium brine, which is what the source of the lithium.
Interesting. And then how do you invest in this opportunity? Turns out we're launching this ETF tomorrow as well. So hydrogen and lithium are being launched tomorrow on the TSX. The ticker of this one is HLIT for Horizon's Global Lithium Producers Index ETF. So it's designed to provide exposure to the performance of global publicly listed companies engaged in the mining and or production of lithium, lithium compounds, or lithium-related components. And we're also hedging any US dollar exposure back to CAD. So in order to, if you're looking at investing in this opportunity, we can provide a diversified approach for a management fee of about 75 basis points. And it being an index as well, it's rebalanced quarterly back to its weight. As you can see here are some of the top 10 index holdings in this index. Yep. Nick, did you want to provide an example?
I'll give a quick overview. One of them? Absolutely. If you look at the top three names, Jiangxi, Ganfeng, Livent, and Albemarle, these are all integrated producers They produce lithium, and they process it, refine it. They'll make end products, batteries, whatnot. So this would be kind of the equivalent of an integrated oil, except for lithium. So they kind of do the upstream all the way to the downstream. And then we also have the miners, Lithium Americas, or Cobre. These are companies that are really just focused as resource companies, as well as some chemical companies who also participate in kind of the lithium economy with the products that they provide. But that kind of gives you a good overview, and covers the lithium economy.
Okay. And the index methodology is similar to the previous one I mentioned. For HLIT, the index is a modified market capitalization weighted index, where the largest companies will receive a higher index weight. It is also capped at 10% at rebalance. It can also include small, mid, and large cap companies. So, in summary, I think we discussed a lot of the demand increase in these commodities, or these alternative energies, and the opportunity to try to increase the supply to meet that demand. We're discussing the fuels of the future: uranium. The ETF is HURA. Hydrogen, the ticker is HYDR, and lithium, the ticker is HLIT, HLIT. So the key features and benefits of these ETFs is, one, providing globally diversified portfolio within one purchase. You can get an access to all of the companies that are involved in that investment. The growing demand that we talked about, the exposure to alternative fuels that benefit from that increased demand of low carbon fuel usage. The big alternative energy transition with vehicles needing more lithium-ion batteries, and hydrogen helping to replace those fossil fuel-based engines. And liquidity, again, one ETF providing daily trading access to those individual securities that might be difficult to own or trade on your own, or to own enough of them that will provide a diversified basket. And we discussed all the opportunities of these investment themes and these alternative energies, but there can also be risks for each, and we've listed some of them here. So we needed to, so they're all obviously factored in by these companies and within the index methodology. So thanks, Nick. Really appreciate the overview on commodities in general, as well as the fuels of the future. I wanted to thank the attendees. I hope they found it interesting and informative. And we're going to get to questions, but just before that, I wanted to remind everyone that we are social. You can call our 1-866 number at any time, ask questions, or send us an email at info@horizonsetfs.com. We're also on Facebook, Twitter, Instagram, and LinkedIn, with a lot of content. A lot of content that Nick provides is on there often. So if you're interested in learning more about this, please follow us on those platforms. So I'll open up to questions, and we got a few different questions, and there's some good ones. First one specific to uranium, and we talked about the reactors. So someone's hoping we can explain the demand, the demand, but also when old reactors will change. New reactors take time to construct. Does it mean uranium demand is going to grow in the next 5 to 7 years, or is it more like 1 or 2 years?
Yeah, I mean, that's an excellent question. There's currently over 50 nuclear reactors being built today in the world under construction, and there's several times that number in kind of the planning stages of getting approved before they kind of hit the ground. So there's certainly going to be some nuclear reactors. They're gonna I think we said 443 reactors are currently online. And there will be some that are slated to shut down in Germany, for example. I believe it's next year they'll be closing the rest of their reactors. But at the same time, Japan has said that they have to restart their nuclear reactors if they're going to reach zero emission. And Japan is a very good example of how nuclear energy can be helpful, just because they don't have enough land mass to put up a bunch of solar powered or wind. It's a very mountainous area, and so they see nuclear as kind of there's one of their solutions. And there's also all the new reactors being built, not so much in the Western world today, but mostly in China, in India, in the Middle East. And I think the potential upside on the demand front is in the West is from the new upcoming technologies of small modular reactors. This is the kind of technology that Bill Gates is working on, and a lot of other companies are working on as well. So for sure, the older reactors are going to they're gonna be some of them are going to be phased out, but there's going to be new ones coming on.
Okay, and then you addressed where that demand is coming from. Okay, the next one's on lithium, and we talked about it how it's the lightest metal and therefore very sought after in the use of batteries. Are there alternatives to lithium, and what are they?
That's good. There are alternatives. There are other ways to produce electricity with batteries. One of the ones I've read about is the vanadium battery. This has some potential in terms of it's not a light battery at all. It would be more for energy storage for renewable, such as solar and wind. So there's a lot of different technologies, but the reason lithium is the leader right now is that because it's become so commoditized in terms of producing the batteries. The Chinese are one of the big leaders in the world, and they've driven down the cost of producing these batteries like 85%. I read in the past 10 years, and so that one of the challenges of switching to a renewable energy is the cost, and so we need to keep those costs low, and that's where lithium has an edge.
Okay, good. And then last question, back to good old traditional oil energy. Assuming the limitation on exploration within the oil and gas sector, how long can the current supply of oil last for the global demand?
I don't have an exact answer for that. Yeah. One thing I do think is that I really like alternative energies. I really like uranium, lithium, and hydrogen, but I also think it's not going to happen overnight. And
right.
And certainly our listener here has a point. There's not going to be very much money spent on new discoveries and new production. And if the big oil majors are an indication, if anything, their production is going to be on the decline. So that should help keep prices steady.
Stable.
And,
yeah.
And I think we're still going to be using oil for the next few decades while we transition. So
absolutely, and less being produced. But as you mentioned, such a small amount is from alternative energy now. Even if that increases, there's still a lot from traditional energy, and with less being produced, that's still an opportunity, and that's why we talked about that last year being
absolutely,
an opportunity.
Yeah.
Okay, I'm going to surprise you with one last question.
Sure.
You only get to pick one: lithium, hydrogen, or uranium. Your investment going into?
I am a little bit privy to uranium myself because we have a better. We know that the price is at a level where new production can't come on, and so whereas on the hydrogen and lithium, very positive demand potential, but there's certainly going to be supply that can come on if prices go higher. Uranium supply will take years to come online. It takes many years to get a new mine approved and permitted, and so potentially, I think uranium, just because of the supply picture,
right.
I like all three of them on the demand side, but uranium maybe has the edge there.
Okay, and I know, and we know you've been a uranium bull for a couple of years at least now, and you've been rewarded there. And sorry to put you on the spot because I know you do believe in all three. And I think all three we've made a case why the demand supply and the increasing demand and the need for more opportunities in lower carbon emission is really going to provide opportunities in these three different areas, and which is why we wanted to have that nice lineup of three fuels of the future with uranium, hydrogen, and lithium. So again, I want to thank everyone's attendance. I want to thank you, Nick. Again, I hope everyone found it interesting, informative, and we've given you some ideas you can think about if you're looking to invest in these areas. So with that, we're going to end the call. And for those that are on the call who registered, you'll get a replay of the webinar in a couple days sent to your email. Okay. Thanks, everybody. Enjoy the rest of your afternoon.
Thank you, everyone.